Hi, thanks so much for joining in. This is the Mutual Fund Show on NDTV Profit, and I'm Mathew. This show gets you actionable insight that helps you make the right financial decisions. Now, equity markets have been particularly rewarding for investors in 2023 and indeed so far in 2024. Even if you had just bought a Nifty 50 index fund at the start of 2023, you'd have so far gained over 22%. And because of that, your portfolio, which should ideally have a good blend of assets, has likely gotten skewed. Why is that not a good thing, and how should you fix it? That is the first topic that we'll discuss today. The second topic has to do with cryptocurrency. And the reason we're talking about it on the Mutual Fund Show is that the US SEC has allowed the setting up of exchange-traded funds that track the Bitcoin. Can you get access to it here in India? And even if you can, should you consider buying them? That's the second topic. Joining me to talk about these two is Kirtan Shah, the Managing Director of Credence Family Office, and Arnav Pandya, the founder of Moneyeduschool. Gentlemen, thank you so much for taking the time and for speaking to us on NDTV Profit. Let's kickstart things with a conversation about rebalancing. And to understand why it's necessary, I think it's important to understand why and how a skew in a portfolio takes place. So Kirtan, I'll come to you first. What is a skew in a portfolio, and why is it not a good idea to have?
Alex, thanks so much for having me on the show. So, Alex, I'll take it from where you left. What has really happened is over 2023, one of the asset classes, which is equity, has moved and given you extraordinary returns versus the other asset classes, right? So now if you built a portfolio around equity and fixed income, and your equity asset class has moved so significantly and fixed income has not moved, it'll actually change the asset allocation that you really had a year ago versus today. I think that is what is one way of looking at how portfolios actually get skewed towards a particular asset class, because that particular asset class would have done very well in the near past versus the other asset class that you would really have in the portfolio. I think skewness in the portfolio happens for another 2-3 reasons. First is aggressive investors typically think that they don't really need anything outside of an equity in their portfolio, and then they have 100% of allocation given to one asset class, which is equity. That's also one way of skewness. Another is the recent performance, right? So you look at the last 12-18 months, and you would typically see that mid-cap, large-cap, mid-cap, small-cap has done 40-45% kind of returns. And hence, a lot of investors typically end up investing in mid and small or probably sectorial funds like the infra and the PSU themes that have really worked. That also brings in a lot of skewness in the portfolio. And finally, I think it is style of investing as well. You typically come across a lot of investors who now only want to invest all the money in passive kind of investing, right? That also brings in skewness to a style of investing. So I think these are largely the reasons why a portfolio can really be skewed, either because the asset has performed or underperformed in the market, or the behavior of an investor is skewed towards one particular way of wanting to do investing, Alex.
Point. In fact, let's talk about also one of the aspects that you spoke about in more detail, because that essentially is what I want to focus today's conversation on, which is a skew that can take place within an equity portfolio as well, which is that if you have invested equally, a third, one-third into large cap, mid cap and small cap, after 2023, that balance is completely out of the window. So therefore, Arnav, the question to you is, in your experience, do people tend to ignore this skew that takes place in their equity portfolios, and how do you fix it?
So you have a very valid point in the sense that it's not just across asset classes that you need to ensure that there is proper balance, but within an asset class also you need to see what kind of exposure you have, because in the overall portfolio construction process, when you have diversification, you will go across, say, in an equity exposure across market caps. Now, the tendency of most people is that when this kind of skewness in the portfolio is due to performance, the basic nature of the investor should ignore it. Because when asset or some sub-asset class is doing very well, I mean, everyone wants to ensure that they ride the wave. So for them at that particular point of time, it makes sense to actually not do anything because things are going so well that the rising tide is lifting the entire portfolio and the portfolio value. So this makes for a good feeling, and which is why a lot of people tend to ignore it, or even when they know about it, they tend to do nothing about it. Because logically speaking, when you know what kind of exposure you have, when you see the kind of, say, extraordinary performance a particular area is giving, at some point you have to at least ensure that there is some balance which is brought about. But people as a whole, or most of them, they tend to ignore this because things are going good for them. Now, this is as opposed to, say, there is one asset class or something which is not performing. If that is the situation, people are more likely to first say that let's get rid of this, let's change this, because it's not performing. So there is a bit of a distinction here.
Yeah, fair point. So then let's talk about how to fix this, right? So Kirtan, I'll come to you. In the past, we've discussed a formulaic approach to this, where you say on an overall basis between equity and fixed income, say if you have a 70-30 or an 80-20 kind of an approach to investing, and if there is a deviance of, 5 percentage points or 10 percentage points, that is very visible. And chances are that that's something that has taken place over the last year and a half or so. So do you have that kind of an approach, and does that do away with the urge to time the market? Because everybody wants to be right when they hit the market. What they don't remember is that they have to be right on the way in and on the way out. And the chances of doing that are not very high.
Rightly put that across. Most of us can't really time the market. In fact, most of us can't even get the first leg of the timing correct. But here, while you are trying to time the market, like you rightly said, you have to be right twice. While coming in and getting out, that's largely impossible, and which is why most of us are not really disciplined enough to stay invested for a long term, is because you probably might have got one leg of the timing correct and got out of the market, but you don't even now know how to get back to the market because markets have ran away from the time that you invested. So I think rebalancing, asset allocation, both of these things really bring a lot of value to the table in making sure that the behavioral aspect of the investor is taken care of, and that brings in a discipline for the investor to stay through the course. Now, while we talk about rebalancing, I probably look at it in three aspects. The first aspect for me in terms of rebalancing is definitely to make sure that the asset allocation has to come back to place. So if the deviation has happened more than 5% from what it logically should have been, you would want to reassess. So let's say you wanted to keep 70% in equity, but now because of the skewness and the way the asset has performed, it has become 80% in the portfolio. You want to skew it back to 70%. The second you would want to do is from a market cap standpoint. Of course, now you wanted to keep 70% in equity, out of which you wanted 33 in large, 33 in small, and 33 in mid within that 70. But because of the way large and mid perform, it has actually taken away a lion's share in the equity size of your portfolio. So you would want to rebalance it back to 33 large, 33 mid, and 33 small. And the third is very important, which is a goal perspective. I always keep telling people that 18 months before you have attended your goal or you are supposed to reach your goal, start making sure that you move out of your equity portfolio and start allocating that money to fixed income, because you don't want to be in a situation that you are about to reach your goal and then there is volatility in equity and hence you are not able to get the amount of money that you really need for your goal. And for me, one last point, I think underperformance in a particular category is an ongoing process, right? So you keep evaluating that. That does not really have to wait for you to do an asset allocation. So that's an ongoing process, Alex.
Fair point. All right. The other aspect we have to deal with is the tax implication of this. So assuming that you are investing in equity, and if it is a long-term capital gain, then you have to book a loss, or not a loss, what am I saying? You have to book a tax, or you have to pay a tax on that, right? 10% on long-term capital gains. Having said that, there is a 1 lakh limit that you can exhaust every year. Do you use that strategically? Arnav, the question's for you.
Yes, definitely, because it's not just a question of the gain which is there. See, whenever you have long-term capital gains, you are obviously going to first use the 1 lakh limit, and then the additional amount will be subject to tax. Sometimes you also have to use the capital loss which might be there due to some reallocation within the portfolio effectively, because it can be used to set off several other gains which might occur either today or in the future. Because whenever you are doing this kind of asset allocation adjustment, you will have some tax implication. But it is also important that you closely look at it from a longer term perspective, because there are many cases where it's prudent to even have a book loss which can be set off against future gains, because you're allowed to carry forward the loss for 8 years. So the chances are that you might have built up a loss during, say, a period when the market conditions are weak. So you are actually carrying forward those losses in your tax returns. And when there is a bull run or the market turns, and that is the point when you start booking capital gains on various holdings in your portfolio, you can then set it off. So it works both ways, but tax implication is very important, because it's not just at the time of sale, but even before the financial year is over, you need to take a review and see what is your liability, because in many cases you might even have to pay up advance tax. Otherwise, the interest burden will start increasing due to non-payment of the advance tax also.
Important points to make. If you are indeed booking some gains, you have to pay advance tax. Gentlemen, we have to slip into a very quick break, but on the other side, I want to talk about that cryptocurrency exposure, and I'm very curious about what you have to say about that. Viewers, do stay tuned. Lots more coming up in just a bit. Welcome back. You're watching the Mutual Fund Show, and we've essentially talked about how you need to approach rebalancing of your portfolio. One last aspect that I want to delve into when we're talking about rebalancing before we move to the next subject is how to deal with laggards in your portfolio. And I want to take that question to Kirtan. Kirtan, this is obviously, so if you're seeing a skew, you need to correct it, but there will be some elements in your portfolio that are outperforming and underperforming. How do you deal with the laggards that are not doing as well as their peers, and obviously you look at it over a period of time? Do you use these opportunities to take them out of your portfolio?
Alex, that's a very interesting question. I think first you have to be very sure of why do you have them in the portfolio. Unless you are very sure of why do you really have them in the portfolio, you will never be able to figure out why are they lagging. And I'll give you an example of what am I saying. So if somebody looks at the performance of a 33 allocated large mid cap portfolio today, then you would technically see that your mid and small have done really well because the markets have done well on those market caps, right? But that does not mean that if the large cap fund has underperformed the small and the mid, you throw them out of the portfolio. It is just cyclical. In fact, 2024 may more likely be that there is a lot of value in holding the large caps versus holding the mid and the small. So in such a situation, when you know that there is nothing wrong with holding the large cap, right, you still continue to hold them. Or let's say, for example, you would have seen in the last 12, 18 months, the value style of investing has done really well. Now, does that mean that the funds that you have in the portfolio that follow growth style of investing, which would have not done well, you kick them out? The answer is no, because that's the primary reason you've got them together in the portfolio so that they bring balance. And when tomorrow the preferable style to the market changes to growth, those funds will start doing well. So I think you will have to actually end up defining what do you really look at as a red flag in terms of performance or in terms of governance or in terms of anything else, the way you are actually evaluating the portfolio. And only on those red flags is where you go ahead and use such opportunities to really get those things out of your portfolio.
Yeah.
But largely you can also, whenever markets are at lifetime high, that's a great opportunity to move out of underperforming fund, if at all not this way.
Fantastic. All right. So we'll talk about that perhaps on another day. But let's shift gears and talk about the latest update on the cryptocurrency exchange, or the exchange that is tracking the bitcoins. That's the latest update from the SEC in the US. Let's first lay the context, right, gentlemen? So in cryptocurrencies in India, there has been a change in the norms on taxation that has made it unattractive, to say the least, to trade and to invest in cryptocurrencies directly. Arnav, can you tell us about the extant rules on the tax treatment of these assets?
Yes. So, I mean, if you look at the cryptocurrency space, the government has laid down very clear norms of how these are to be taxed. The first thing is that any gain which you make on investing in crypto assets, a flat 30% tax is levied. So there is no deduction, nothing. You get to pay a flat 30% tax. The second point related to this is that unlike other assets, capital assets, where you can set off the capital gains and losses, under crypto, you cannot set off any capital loss that you make on an investment against a capital gain. This is a big blow because there is no netting effect. All gains, you have to pay a tax. So that makes it a flat tax of 30% on it. So this is the second point. And there is, in addition, there is also, whenever you make a transaction, there is also 1% TDS which is levied. So this adds to the burden which is there. And ultimately, if you look at crypto as an asset as compared to any other asset class, you will find that the rate here is far higher than what the other assets would normally end up paying on a net basis.
Okay, fair point. The next question then, Kirtan, comes to this latest update, and the update is essentially an approval by the US regulator for certain entities to start up exchange-traded funds. Those funds are now active and billions of dollars have already been traded in those exchange-traded funds. The question is, can an Indian transact and buy these ETFs, and how do they do that?
So Alex, I'm assuming because there is no news that has particularly come out from Indian authorities that they can't, I'm going ahead and assuming that they can use the LRS route to invest money in these ETFs like they would have done otherwise, using the LRS route to try and invest in any asset or any product abroad. So up to 2,50,000 dollars that you are allowed under the LRS route. In the absence of any commentary so far from the government, I'm assuming that this route is still open for an LRS transaction that anybody can use like they would have otherwise used to do any transactions to invest globally.
So that's $250,000, right, that is available?
Yes.
So that's a considerable amount of money. The question is, how are they taxed then? It's the same taxation for anything that is invested through the LRS route?
Because this is going to be a mutual fund investment that these guys will largely do. I'm assuming that the tax will stay the same that it is, which is at 30%.
Okay, 30%. So, forgive me, I thought that this was on the slab rate. Anything that you book and you bring back to India is taxed at the slab rate. Is that right?
Oh yeah, I mean, because I'm assuming that anybody who's transferring $2,500 is in that tax bracket, which is why I said that.
No, fair point. Because I'm assuming that anybody can do that, and the reason I make that clarification, Kirtan, is that a lot of people with a lower income have also, and this is factual, this is data. A lot of people have traded in crypto in the past 1.5 to 2 years, not in the recent past after tax changes, but there was a lot of interest in crypto. That's why I asked that. So essentially you get taxed at your slab rate. Now the question is whether or not you should do this. And I will come to you first, Arnav. When it comes to an allocation, a lot of people are talking about the future for crypto, and they're saying that it's not going anywhere. I, for one, have not understood it. I'm very curious about what you think about the approach that an investor should take, whether they should take this route and take a small allocation to a crypto ETF.
Well, the question first here is that there should be a good enough reason for you to take this kind of allocation to an asset like cryptocurrencies, because one part of the argument is that it's the future, this is how it's things are going to be, the blockchain is where the financial industry is moving, a lot of things will go there. But at the same time, when you are investing, there is also the question of how do you value a particular asset. And when it comes to crypto, you can't do that in terms of your normal traditional valuation matrices, because of the fact that this is just not possible. So if you are an investor who believes that you are looking at investing principles while you are constructing your portfolio, then this is not for you. But what we have seen is that a lot of young people who, in fact, might not care too much about the investing fundamentals, principles, things like that. For them, crypto is an attraction because it was rising in value. So for them, they were taking an exposure here. But my personal view on this is very clear that conservative investors should not take exposure to this particular asset. Yeah. And the second part is that at the present moment, the way you are going to go about it through the LRS route, there are a lot of complications involved, because one also has to remember that now under the new guidelines, whenever you take money out of LRS, the moment it crosses 7 lakh in a year, you have a 20% TCS. Okay. It's a big figure because it's draining your cash flow. Yeah. The second part is that in your income tax return, the details which you also need to give for all these investments has now also been tightened quite a bit. So that also needs to be taken into consideration.
Fair point. Kirtan, I want you to have the last word on this. People have argued for a 5% allocation to crypto or to something like an ETF, like you would have for a sectoral fund. Is that an appropriate strategy?
Alex, very honestly, I come from the school of thought where I believe that such a small allocation won't really make any difference to your portfolio at large. So if at all you want to do this 5% from a tactical bet like you would do in sectorial funds, then that's one school of thought that professional investors can. But largely, I think from a retail investor standpoint, you are better off avoiding to invest in something that you don't understand. And that's my larger advice to retail investors watching. But of course, if there is a tactical bet that has to be taken, you can allocate 5%, but you really need to understand how to do it.
All right. And just as a closing point from my end as well, there's no dearth of options. As we speak, the equity markets in India are hitting life highs, and we will talk about that in just a bit. But gentlemen, thank you so much for joining in and for giving us the perspective that you did give. As we end on the mutual fund show, you have the Nifty 50 that's nearing 21,900, and that in fact is a record high. Do stay tuned. We're back to the markets in just a bit. This is NDTV Profit.